So the methanol capacity has increased rapidly, and this will be leading to exports. Although we're going to show that for good economics, you need robust methanol prices, and we'll present that. Also, as this is to get more robust methanol prices, the sort of wild card here is that the big demand or growing demand is in an area towards chemicals, a route called methanol to olefins, or MTO. And depending on how this segment is doing, creates a lot of more volatility for methanol prices.
Okay, so the methanol story is certainly commodity chemical. It's all about supply and demand. And China is really the demand driver. It's over 50% of global demand right now. Wo-ai Zhongguo. So I love China. India is the third largest energy consumer in the world. And as we heard earlier, you know, they've got significant air quality problems as well. And they've announced just at the end of 2017 to follow China into a methanol economy. And you track the growth in methanol demand in China over the last 10 years, India is a real disruptor. Well, there are a lot of good analytics companies, ADI as well as a host of others that publish methanol statistics. Most of that shows the rest of the world fairly flat. I think the change comes with fuel. So the marine fuel, you know, if you look at particulate emissions from bunker as opposed to methanol, you've got a 95% reduction in particulates. If you look at, you know, SOx as an example with the high sulfur, you've got no SOx for methanol. So that's probably going to be the driver for that. Europe's doing a new initiative on renewable fuel. If we were to recycle a portion of our CO2 and make that 5% of our product, it would qualify for renewable fuel standards in Europe. So there are opportunities there. But the demand growth is so high in China, and now with India coming on, that's a massive game changer. That's not really a story in the market yet.
That's right. India is maybe not quite the black swan, the gray swan in the future.
Yeah. This is our plant. I'm going to move fast for the sake of time. We're building would be considered a mega methanol plant. 4 phases, 7,200,000 tons per year, total capacity, multi-phased project. People ask me, well, that's a lot of capacity. In fact, 2 Chinese groups, Northwest Innovation Works and Fund Canal, had announced over 20 million tons of US capacity, and none of that's getting built right now. So there's a gap. That capacity was used in China to authorize some MTO plants. So you're running into MTO methanol supply shortages, which spiked the price close to $600 as recently as the last 3 months. Basically, it's all about scale to make this work. And, you know, frankly, I would have a little disagreement with some of the analytics on profitability. We save money by putting multiple projects on the same site. And we're really an infrastructure company and a developer. So our business model has reduced our break even and cost of capital significantly. So you add to that advantage shipping 2 to 3 times the cargo size. It makes for a nicely profitable project.
So actually our main business focus has always been on large-scale production, and it's really focusing on economy of scale, so the larger the better, the process economics. But we saw some we saw some quite significant pull from the market for smaller scale production, and we always try to be at the forefront of any developments. We are a heavily research-based company, so we took it as a challenge to go into the small scale gas monetization market, and that has turned out to be a very good thing for us, or at least we think it'll be a very good thing for us in the few years to come. But I'll start by mentioning talking a little bit what is the difference between production in small scale and production in large scale. As I mentioned, the traditional focus has really been economy of scale, because when you look at the process economics, it always improves the larger you go, if that is you can sell your product at the same price essentially. And there's a lot of focus on energy consumption, because traditionally and particularly in large scale, the energy cost is a significant contribution to the overall operation or the overall production cost. That is true even for quite cheap natural gas. When you shift to small scale focus, the capex contribution to the overall production cost is much more significant. And one of the reasons is that there's a huge engineering cost associated with building the first plant. So this, of course, becomes, because the engineering cost is essentially the same for a small scale and for a large scale plant. So therefore, the capex contribution is much, much larger in small scale, and therefore you need to shift your focus slightly. One thing we have realized from the beginning is we don't want to compromise on the quality, we don't want to compromise on the safety and other fundamental parameters like that. So for that, we are completely at the same level as large-scale plants. It's important that you select your size of the plant well, because the concept that we're going to use is design one, build many, in order to reduce the impact of the high engineering costs. So if you only design one plant, then you have to make sure that the size is appropriate for the market. And we have found sort of a sweet spot around 215 tons per day methanol, which corresponds to 7.5 million scopes per day natural gas. I think it's somewhat of a threshold with this large engineering, this large initial cost that we're seeing in small scale. So I think we need a different business perspective. Instead of looking at the economics for plant number one, we need to look at the economics for a number of plants. And that's not something new. We have often been approached by clients who say, well, you will get your money when we design plant number 3 and 4. So they know this way of thinking already, but I would like the other guys to think that way. So they need to be prepared to pay some more money for the first plant and then be able to gain on the subsequent plant. I think if we could have that kind of change in business perspective, that could be, but something needs to be done with this high initial cost.
But in general, it's typically a blend of methanol, ethanol, formaldehyde, and water. So a little bit of a picture of how that works is we go to the wellhead. Instead of building a chemical plant, we're trying to work more in the oil and gas space. So that changes a lot of the dynamics of how the process is put together, because oil and gas does not translate very well to the chemical industry. So we needed to really go small and we needed to go simple. So how it works, in a nutshell again, is we take flared gas, because we always go for the low-cost feedstock. We use oxygen or air, and we have a recycle loop. So what we do is we take that gas, race it around in a racetrack, convert a small amount of it every time, separate out the liquids that were produced, try to scrub out some of the byproducts that are produced in the process, and recycle that gas around and continue over and over and over again until we get a reasonable conversion.